Hello, everyone. Let's start our midterm solutions discussion. So we are only going to cover part 1 and part 2 problems, which include calculations. So for part 1, we're going to start with question 3. And for this question, you have to find the return on capital employed and the payback period. So as you know, for return on capital employed, there are two formulas. First one is given as average operating profit divided by initial investment, and the second one is given as average operating profit divided by average capital investment. So for this particular question, it was given that you have to take the average capital investment. So let's start with the calculation of average operating profits. So operating profits for 5 years was given as 25, 28, 14, 18, and 10. So you sum up all 5 figures and divide by 5 to find the average operating profit. And next step is to calculate the average capital investments. And for this number, you have to add scrap value to the initial investments and divide by 2. So 60 plus 0 divided by 2 gives us $30. And the last step is to find the return on capital employed, which is 19 divided by $30, which gives us 63.33%. So next step is calculation of payback period. The difference between calculation of payback period and the return on capital employed is that for return on capital employed, we use the earnings before interest and tax, which include depreciation expense. And for payback period, we use the cash flows, which are real cash flows, which means that without depreciation expense. So you have to add back depreciation to operating profits in order to come up with cash flows. So basically for the first year, 25 operating profit plus depreciation expense of $12, which gives us $37. So you find the cash flows for every year, and next step in finding the payback period is to find the period when negative cash flow turns into positive. So basically it's between first year and the second year. So which means that we have one full year for payback period and one partial year. So how do you find the partial year? You divide the last negative cash flow by, not negative cash flow, but the accumulated cash flow. So accumulated cash flow is a sum of all the preceding cash flows. So 23 divided by upcoming positive cash flow, which is 40. So the result is 0.58. And the final number is a sum of full years and the partial years, which is 1 plus 0.58, which gives us 1.58. So next question is to find the discounted tax savings. Initial investments were given as $100,000. Reducing balance rate is 25%. Disposal value is $20,000. So the idea behind this example is that you spend a certain amount of money to buy certain asset, and then we are going to incur depreciation expenses every year, but we're not going to pay taxes on those depreciation expenses, which means that we have savings on tax for this asset bought. So disposal value is the amount of money that we're going to sell this asset after its useful life ends. So to find the depreciation expense, usually for these kinds of example, we use the reducing balance rate approach. So you multiply the initial investments of $100,000 by reducing balance rate, which is 25%. So $25,000 for the first year. And next depreciation expense is the initial investments minus first year depreciation expense multiplied by reducing balance rate. And the same for the third year. So basically for each year, we subtract depreciation expenses of the preceding years and then multiply by reducing balance rate. But the calculation is different for the last year. You don't have to include the reducing balance rate in your calculations. We only take the initial investments and subtract all the preceding depreciation expenses, and the last item is disposal value. So basically $100,000 minus all the depreciation expenses minus disposal value, which gives us $22,000. So next step is to find the tax savings. So tax savings is calculated as depreciation expense for the year multiplied by tax rate. So tax rate is given us 30%. So $25,000 multiplied by 30% gives us $7,500, and the same for the second year, third year, fourth year. And those are tax savings for 4 years, and the sum of these four numbers gives us $24,000, but this is not the present value yet. You have to discount those tax savings in order to find the correct answer for this question. So how do we discount? It was given in the task that tax is paid in arrears, which means that if you sell items during the first year of operations, you pay taxes at the end of the second year of operations. So basically, the first tax savings are going to occur at the end of the second year. So these first tax savings, $705,000, are going to be divided by 1.1 at the power of 2, meaning that this cash flow is occurring at the end of the second year. And the same for the second year depreciation expense, we are going to discount it by 3 periods. And the third cash flow is going to be discounted by 4 periods. And the fourth cash flow is going to be discounted by a fifth period. So basically, you just discount all these 4 figures to find the discounted tax savings and sum them up, which gives us $17,439. So the next question is given as, so this question is on also time value of money. Initial investments are given as $50,000. And the idea was that we have these initial investments and we want to put them in deposit. And in 7 years, we are going to take those money in order to purchase perpetual bond. Perpetual bond meaning that there is a bond paying a certain amount of money forever. So to find the task was to find the growth rate. So how do you find the growth rate? First, let's start with the calculation of deposit amount. So $50,000 in 7 years are going to turn into $77,700. So basically, you have to multiply $50,000 by 1 plus 6.5% as the power of 7. So the deposit account in 7 years are going to have this amount of money. So we are going to use this money to purchase a perpetual bond. So which means that this amount turns into PV of perpetual bond. So what is the formula for perpetual bond? Is PV is equal to cash flow divided by R minus G. So PV is calculated as $17,700. And cash flow is given in the task as $4,000. So we divide by 6.5% minus G. And using the mathematical calculations, G is calculated as 1.35%. And next question is question 9, and the task was to find the appropriate equivalent annual cost and the year when you have to replace the asset. So this is a question on asset replacement period. So we had 3 different options to replace either after first year of operations, second year of operations, or the third year of operations. So the initial investments are the same for all 3 options, but the following expenses and the disposal values are different. So you have to calculate the annual equivalent costs for every option separately. So for the first option, calculations are given here. So we take into account the first initial investments for year 0, which are given as minus $9,000, and for the first year, operation expenses were minus $2,500, and we have disposal value of $7,000. So expenses usually come with minus sign, and this disposal value is an income for us because we sell those assets and receive money in turn. So that's why it was added to our cash flows. And this figure 4,500 is going to be discounted by 1.1 to find the discounted cash flow value. So discounted cash flow for the year 0 is minus $9,000, and for the first year, 4,091. So sum of these two figures give us minus $4,900, and the formula for equivalent annual cost is sum of costs divided by discount factor. So how do you find a discount factor? For the option that contains only 1 year, you just divide 1 by 1.1. So discount factor for this option is 0.9. So you have to divide this. Formula is given as costs. So costs come with minus sign, which means that there is no need to include minus in your calculations. You just take this 4,909 and divide by discount factor of 0.9. So this gives us $5,400. And the same for the second year. So you take the initial value of minus $9,000, and for the first year we have some operating expenses of related to this asset of $2,500, and for the second year you have minus 2.9 cost, and we have disposal value of plus $4,000. So sum of these two numbers gives us $1,100. And the same as the preceding option, you just find the discounted cash flow by discounting first year cash flow by 1.1 and discounting second year cash flow by 1.1 in the power of 2. So sum of these three figures give us minus $10,000, and the discount factor is the sum of 1 divided by 1.1 plus 1 divided by 1.1 in the power of 2. So basically, this is denominator of this discounted cash flow numbers. For instance, if you take this 1.1 for discount factor, you're only going to include this 1 divided by this figure. And for the second year, you include 1 divided by this figure. So sum of these two numbers gives us 1.7. So to find the equivalent annual cost, we divide this 10,000 cost by 1.7 discount factor, which gives us $5,900. And for the third year, we find the first year costs, which are minus 2.5, second year costs, which are $2,900, and for the third year, the costs are minus 3.4, and we have disposal value of 3,000. So sum of these two numbers gives us minus $400. You discount all the cash flows by appropriate periods and find the sum of discounted cash flows. So sum of discounted cash flows in this case is almost minus $14,000, and the discount factor, as in the previous example, is 1 divided by 1.1 plus 1 divided by 1.1 to the power of 2, and 1 divided by 1.1 to the power of 3, because we have 3 periods. And so sum of these numbers gives us 2.5 almost. And to find the annual equivalent cost, we divide $14,000 of cash flow by 2.5 discount factor, which gives us $5,600. So in this case, to find the optimum replacement period or optimum replacement cycle, you find the equivalent annual cost, which is which has the smallest value. So in this case, the value of 5,400 is the smallest one, which means that the optimal replacement cycle is after first year, because this gives us the highest biggest value in turn. So, and the last question was to calculate the profitability indexes and the right sequence of project undertaking. So 2 figures were given: capital required in year 1 and capital required in general. So in general means that at the time of undertaking the project. So the scarce source, which means that limited resource, is first year capital. So you have to take not the total capital required, but the capital required in year one. So to find the profitability index, the formula is NPV divided by limited capital. So limited capital, as I said before, capital required in year one. So we divide this $590 by $190. So, and in similar way, we find the profitability indexes for all the 4 projects. So the highest profitability index is 4.75, which means that you have to undertake this project in the first place, which is project C. Second highest is D. Then we have A and B. So the correct order is C, D, A, B. Which means that if your capital is limited in the first year of operations, you have to take into account those numbers in your denominator and find the highest profitability indexes and just rank them in descending order. That's it for the part 1.